Here we go.
And we are good.
Back, everybody. Welcome to the Corridor Cast. We got a lot of requests from the audio-only crowd to state who the heck is on the podcast before we get too deep into it. So for all you audio listeners out there, today we have special guests Nico Peringer.
Hi.
We've got Wes Wasgood Armstrong. We've got Christian Fergerstrom.
Oh, hello, hello.
And, of course, Clinton, the one and only Punisher Jones.
That's me, everybody.
And, of course, your host, me, Jake Watson. So, Wes and I were chit-chatting the other day, just, kind of about life and about what does it all mean and how do you prepare for moments like a quarantine and what do you learn during moments of a quarantine. And we came across the topic of personal finance. And so I'd like to caveat this first and foremost, this whole conversation. None of us here are financial experts. You guys all know that. We don't normally offer financial advice, and we're not offering financial advice here. We're just telling our tales. But what we'd like to do in this podcast is sort of give you a perspective on where each of us are at with our personal finances, what we learned, how we learned it, how we came to learn those things, and hopefully that'll give you a little bit of a perspective on what just some other average Joes across the state or across the world are doing for themselves and trying to weather the storm of a quarantine and things of that nature. So welcome, and I'm glad everyone's here, guys. Thanks for joining.
Yeah, I'm happy to be here.
Thank you for joining me on our podcast.
No, thanks for having me. Yes, happy to be here, ready to learn, share information.
So with that said, I mean, I think the first and foremost thing that we should kick it off with is just at what point in your life did you start to think about, hey, finances? Maybe I should save. Maybe I should squirrel a little bit away. What was your first experience with personal finance? And it can be a tale from when you were a kid, or it can be just as recently as yesterday. But I'd like to kind of kick it off with that and see where that goes.
I think we started last week. Or no, sorry, not last week. Maybe at top of the quarantine. Just like, what is it about financing and money that I do not know? And so I started out with, I looked up a bunch of things on like just finance in general, like how to grow your money. And I came across Rich Dad, Poor Dad. And I listened to the audiobook and I just haven't stopped. So like for like the past month, I've been knee deep into everything finance.
So did it come from the fact that you were sitting there and you watched the Dow Jones Industrial drop about value in about 3 days?
Yeah, no,
like, hey, what's going on here?
Through different conversations around, you hear people say, "Oh yeah, the stock market's down. Yeah, it's time to invest." And I'm like, "What are you guys talking about?
What does that mean?"
Exactly. What does that mean? And nobody was really giving me information. I felt stupid asking, "What does that mean?" So I just went to Google. I was like, learn about stock market. Like what books did I read? And a whole bunch of books came up, and I was like, all right, I hear about Rich Dad Poor Dad all the time. Let me just go through this and see what's up. And it just kind of opened my mind to so much stuff that's going on that I had no idea about, in terms of stocks, in terms of how to manage money, in terms of how to, like, when you get money in, how to pay yourself first, but then invest, just take 30% for investments and tithing and saving.
So let's start with that first. Question. Like, we all saw what happened in March and the Dow Jones Industrial. It went down from it was almost about to cross 30, and it went down to 19.
Where are you looking at that?
That's just on. Just Google literally Dow Jones and go to 5-year view.
He's got one of those little things that sticks out like the white tape under like a glass dome.
If I have my assistant look back on the ticker, so that's the first thing. It's like when someone says, "Hey, it's March 20th. The Dow Jones has gone from almost 30,000 to 20,000. It's a good time to buy."
Yeah.
Mm-hmm. What does that mean, in your
Well,
opinion?
what it means is, so, when you start investing, you also need to start being aware of like what currency is and how it works. And so like if you buy one stock for $10 and there's your Dow Jones illustration. If you buy one stock for $10 and then
Go to 5 years.
a couple days later, that one stock is now worth $20. It's important to keep in mind you're holding on to this piece of property, which is basically a share of a company usually, but it can be, some goods. It can be like a barrel of oil that you own, et cetera. But at the end of the day, it really just it's money that's going into the hands of other businesses for them to work with. Much like how money goes into a bank's hands for them to deal with giving out loans and things like that. But when the value changes, it's really actually kind of changing the value of the dollar in a way, the money that you use to buy that thing. So right when the stock goes down, right, when the stock market goes down and all the prices dip down, if you happen to be holding dollars, your dollars have become more valuable. The stock's value relative to a dollar has gone down. So that's a good time to buy because basically you can think about the fact that assuming that the stock will go back up, it's basically on a discount. Your dollar's worth more valuable. You can put it into the stock, which is less valuable, but which historically is more valuable, and then that value goes up. Now, you have to be careful if you're buying individual stocks. Companies are not guaranteed to succeed. That's why one of the things we'll be talking about here are things like index funds, which are basically a risk management way to approach stocks and bonds and things like that, where you can spread out your dollar amongst lots of different companies evenly. And at that point, you're buying into the economy. If you think that the American economy is going to go down, you should not invest. And by go down, I mean permanently go down forever. And if that does happen, we have many other bigger things to worry about than how much retirement savings we have. But historically, the American economy has grown to the rate of about 7% every year. Some years are down years. Some years are huge up years. Like I think last year was like 15% in terms of growth. So it all evens out in the wash, as they might say. So the idea is that when you're doing investing, not in the day trading sense, but in the casual, put some money away for later, save for retirement sense, you're kind of just betting on the entire economy to continue going up. And ideally your money grows at a 7% rate every year. Now, the thing that catches a lot of people by surprise is the fact that inflation, which goes up about 2.5% to 3% every year, inflation is making your money less valuable if your money is just sitting in a savings account. So if you put $300 into your account to buy an Xbox 10 years ago, well, guess what? Xboxes now cost $400, and those $300 are worth less than they were, 10 years ago. So if you are saving money, if you don't want to lose money on the fact that you are saving money, you need to make sure that money is invested in a spot where it's going to grow faster than inflation. And what you don't want to do is expose yourself to a bunch of risk in that process. So yeah, that's why things are at a discount right now. That's why people say you should buy right now, is because the stock market is down, but historically it's going to go back up. And also we can really pinpoint why it's down. It's the coronavirus. It's obvious why it's down. Now, if there's huge economic impacts from that we don't know yet, that's the risk that you kind of take, because there is a risk when you invest. But your dollars right now, if you happen to have liquid dollars, they will buy you more stock than they did, 3 months ago when everything was at its peak.
What does this number mean, Nico? Right here on the Dow Jones.
What's that?
This number right here.
Which number?
You're not screen sharing again.
I'm not screen sharing anymore?
No, tell us for audio anyway too.
Oh, you know what? They're trying to update my system on this.
Windows needs to update.
Oh, there goes Wes.
Are you talking about by Wes?
God,
dude, he just got updated so hard.
Hey, Wes has left the chat. He'll be back.
He'll be back.
I'm assuming the number he was saying was the number of Dow Jones. Dow Jones at 24,630.
Yeah.
Yeah. What is that number?
Nico, well, actually, here, go ahead. Let's answer that question. What that number is? I don't know what that number is.
Well, there's only 30 stocks in the Dow Jones, and that's the average. So I don't know the actual specifics of how they get that number, but I do know that it is some form of average. There's some sort of averaging arithmetic based upon the 30 stocks that are in that exchange that create that value.
Yeah, you also have the S&P 500, the Russell 3000,
the NASDAQ. Yeah.
You can basically look at the Dow Jones Industrial Average as an index fund in a way. And you can actually buy index funds that basically match the Dow Jones Industrial Average.
Yeah.
So that overall, as that number goes up and down, so will your money that's invested in it. The value of the index is the sum of the price of one share of stock for each component company divided by a factor, which changes whenever one of the component stocks has a stock split.
Right.
It sounds like it's basically all the stocks added together.
Yeah, effectively, yeah. That's
So if you wanted to buy one stock of every company in the Dow Jones Industrial Average, that's how much it would cost you.
you'd have to spend 25 grand.
Yeah.
So there's a lot of fancy words being thrown around, like the Dow Jones Industrial and index funds and mutual
Let's
funds.
take
and
it.
like,
Let's
so,
take a step back.
Yeah, take it back a little bit.
Back. What is interest? Where does it come from?
Well, actually, I'm going to throw out there that if we start getting into the nitty gritty of these things, we're going to get bogged down because we're not professionals. I think we're going to be better off just talking about our experience with this and like how we approach it.
Which service do you go through, Nico?
I'm a big proponent of Vanguard. So, hey, everybody listening to this podcast is thinking about investing. At the end of the day, you're probably going to want to look at Vanguard as your go-to once you kind of have your head wrapped around it. If you're just looking to get started and do something simple, something like Betterment, which is what Clint and Christian have just kicked off with, is a great way to start. Vanguard is when you're going to want to get a little more serious about it.
The beginning one is Robinhood as well. I mean, like, there's so many options out there. Like, I messed around with like a few different ones. I did Robinhood, and then I did Yahoo Finance, where like Yahoo Finance gives you kind of like live updates of what's going on currently in the stock market during the opening hours. And then I just went over to TD Ameritrade and sent everything from my Robinhood over there. And I only like that one. I like that one right now because it has like education. You can literally take classes on there about everything that's going on. So if I want to know about mutual funds or ETFs or stocks and bonds, I can literally take a 3-hour class, read it, test me in person, and just continue going.
that's awesome.
But here's the catch, and like here's how people get screwed. This happened to a lot of people with 401ks, which led to them passing laws over it. So anything that's a fund where it's a collection of things, somebody's managing the fund. Even if it's not actively managed, some company still has to set it up and manage it, and they will charge you fees to do so. So Vanguard, for example, for their stock market index fund, which is literally just a composite of the stock market, it represents the overall stock market. It's a very simple thing to set up. You just look at the stock market and you take an average of all the different companies and you buy into that. There's not a lot of active managing there. That has a 0.04% fee to use. So basically, if you have $1 in there, it's going to cost you 4 cents. Now, sorry, I said that wrong. It'll cost you, if you have $100 in there, it'll cost you 40 cents. That's how much it'll cost you. So it's a really low fee. However, something like their retirement fund, which is set up in a different way to be actively changed a little bit each year, that has a 0.25% fee. So if you have $100 in the market for that, you're looking at $2. Man, my math is so bad. 1%. $100 would be $1 would be 25 cents.
It'd be 25 cents.
Yeah. It'd be 25 cents. Whereas, sorry, the other one I said 40 cents, so I meant to say is 4 cents.
4 cents. Yeah. Okay.
Yeah. So it's a 4 cent fee versus a 25 cent fee on $100. Now, what the catch is, if that fee is too high, let's say the stock market or the fund you have averages a 5% gain every year, but the fees are 3%. What that means is you're only going to make 2% on that fund every year, because for all the 5% that you gain, the company is then going to take 3% of that back. And at 2%, you're not going to beat inflation. You'll be losing money. So you have to be really careful with all the funds that you're picking out that they don't have really high expense ratios, because that really adds up over time. And if you're paying more than, say, a 0.1 to 0.2% fee on something, you're probably paying too much. Once you get up to like the 0.4s, you're starting to get a little screwed here. Vanguard is known for having really low fees, which is why I recommend it to anybody when I start talking about investing.
Draw your money. This is the charge that's going to be associated with it
per year, right?
This is just a charge that they charge you to have the money in their fund. Yep, and I believe it's per year. I could be wrong. It might be per month or something like that, but it averages out to be that percentage.
So I'm looking here that Betterment and Wealthfront both charge an annual fee of 0.25%, like you're saying. Mm-hmm. If you want someone on the phone, an advisor on the phone, it's going to be 0.4%.
Get me an advisor now. Tell me how to do this.
But the reason, so 0.25%
That's not bad.
Yeah, it's not bad. It's like basically on autopilot. It's an autopilot thing. Like you set it up, you set all your parameters, you set your goals, you set how long you want it to go. You set how risky you want it to be. You set the percentage of stocks versus bonds, and each account, like you'll have a savings account or you'll have an investment account. You can change the percentages and all that stuff. But it's auto, and for me, like I'm just getting started, so that this is what I need is like just like an auto kind of thing to see how this works, and then maybe in the future go to was it Vanguard?
Vanguard, yeah.
And that's manual. That's like a manual, like kind of take the training wheels off kind of situation, I think, right? And that's why the fees
doesn't have to be. It doesn't have to be because Vanguard's set up to. I mean, you're right a little bit, Clint. Betterment's a little bit simpler, but Vanguard's really not that complicated. Because if you just want to be simple and automatic, you can have Vanguard automatically take money, like say once per month from an account if you want, and then you can have it automatically put it into a fund. And if you don't want to think about it, all you do is you pick a retirement fund for the year you want to retire, and that's it. It'll do all the risk management for you. It'll do all the balancing for you. It'll be like, okay, so if you're going to retire in 30
they
years,
will. The people that run it will.
Yeah, you're like, which is the same as Betterment, basically, at that point. It's like, okay, if you're going to retire in 30 years, we'll give you a slightly higher risk, and then as time passes, the risk will go down, and then basically the amount of bonds and safer investments will go up in that account. You don't have to do anything. You don't have to think about it. You don't have to research it. You just buy the retirement fund for the year you want to retire and call it a day.
TD Ameritrade doesn't have any. I was looking at annual fees. TD Ameritrade doesn't have any annual fees. The only fee they have is like 75. Okay, it says no annual activity. I was about to say I seen something for 65 cents, but it has a $75 full transfer fee, $0 partial transfer fee when you're like closing.
But what's the name of the fund that you own?
No, it's just I'm just kind of going
to trade individual stocks, is it not?
No, this is going for everything. No fees for non-transactional fees or mutual funds. It says number of non-transactional fees for mutual funds more than.
Those are fees per transaction that's talking about there.
Per transaction, but we're talking about annual fees for having an account, correct?
Yeah, for not having an account, for owning a fund. So anybody who has an index fund is going to charge you, or mutual fund or anything like that, is going to charge you a fee because they do have to deal with paperwork and managing it and that kind of stuff. So you should see either a cost ratio or a cost fee for the specific funds that you have, because TD Ameritrade is just a company, just like Vanguard is just a company. There isn't a Vanguard fund. There's specific funds within Vanguard that you would buy. So like I have the retirement fund, for example, and I also have the total stock market index fund, which I put a little bit of money into when the stock market went down, because I anticipated that it would go back up. So the stock market fund fee itself is only 0.04%.
Mm-hmm. Maybe I put inside the chat what I was looking at just now. I don't know how I was compared against this thing called NerdWallet, but I just wanted to kind of see like what the.
Yeah, you need to know what actual funds you own within TD Ameritrade for us to look up the fees on those. But the fee thing is really important because it catches you by surprise. Because things like 0.25%, 0.1%, that all sounds really small. But let's say, once again, let's say you're making 6% on your investments. Well, 3% of that is inflation, just to keep up with inflation. So in reality, your actual investment growth, your actual money growth is only if you have 6%, but 3% is inflation, then your actual growth is only 3%. And then let's say you're paying a fee of 0.5%. That's cutting into your actual wealth by an entire 6%. You're giving away a sixth of all of your money that you are making the company for that, for them managing your money. And that really adds up over time. That becomes a lot of money. So you have to be careful with those fees because what seems like a small percentage does become big as time passes.
Yeah, if they're taking a 4% fee, and you're gaining,
even just like a 0.5% fee or 0.4% fee. That's not huge, but that's still,
but for comparison, like if they say it's 2%, which is, pretty normal. But you're only gaining 5% a year, then you're really only gaining 3% net. And
then there's interest or there's inflation that you have to beat.
And then so you're Yeah. So yeah, that's super important. And I think we should, before we kind of went everywhere. I think let's take it back. Let's talk about fundamentals here. Let's talk about like, for starting out, what are some of the things you have? Okay, I'm Joe investor. I've got $100. I don't know anything. What do I do? Where do I go? Where do I put it? Like,
all right, let's each take one turn doing a 1 minute piece of advice.
Do I buy a share of my favorite company or?
Yeah. I guess I'll go. I would say, research the company that you're interested in. Like there's a lot of, there's always he say, she say, but like your research is probably the best. Find out more about the company, because what I've noticed.
Don't put if you only have $100 and you're investing for the first time, don't put it into a single stock.
Exactly. Yeah. Spread it out. What okay.
That's gambling, right?
That's rule number one.
That's pretty much gambling.
Rule number one.
Yeah. Don't put it all in one, but like research the company and just kind of like spread it out and just look and see what it does. See what this $100 does with, get up in the morning when the stock market opens and watch and notice how like, the stock to me kind of moves off of emotion. You know what I mean? As soon as Elon Musk says something, like take for instance when
you're breaking rule number one. You're breaking rule number one, Wes.
What's breaking rule number one?
Don't invest if you have $100. Don't put it into a single company.
Oh yeah, no, I believe it.
Where
did I go left at?
What's that?
I think you're just because you're focusing on do the research in this company that you like.
Oh yeah, sorry.
I'm just saying, like broad strokes, like the big, like you're looking long term. You're like, how do I save for retirement 30 years from now, 20 years from now? Like, buy a fund first is the first thing, and do it through a company that's safe, and do it through a company that's tried and true, and do it through a company that has low costs on the money that you're putting in. So go to people that already do it with trillions of dollars. Try to find one that has a low interest rate, a low take rate on the money that you give them for that fund, and start there.
You're saying a mutual fund first with a well-rounded company.
Yeah, like start there. Take your, if you've got $100 and you're starting out, take 90 of them, take 80 of them, and start there.
Okay.
Well, first, actually, I'll my turn.
That's what I would
do. Go for it, Nico.
Okay. First things first, you need an emergency fund. So take your living costs, take 3 months of living costs. That money does not go into the stock market. Money does not go into investments at all. I would take the money, I would put it into Ally. There's an online bank, Ally Bank. They have a savings account. It's 1.5% to 2%. So your money, at least you can put it in there. It's at no risk. It's not, subject to any stocks or anything like that. At least grow at 1.5% to 2%. So take your emergency fund, put it in there. Everybody should have an emergency fund. We just demonstrated in real life this past 6 weeks that everybody needs an emergency fund, because suddenly your job disappears and you are out and you are floundering and trying to figure out where your next meal is going to come from. So you need to at least have 3 months of living expenses saved up in your emergency fund. And like I said, put it in an Ally account, let it at least get 1.5% to 2%, because that adds up over time.
That's number one, right? That's number one.
That's
like before you even invest.
Before you even invest, yeah.
That one gains interest over how long? It gains monthly interest, yearly interest, annually interest?
Monthly interest in an Ally account. Yep, you'll get 1.5% to 2%, and that fluctuates as the market fluctuates, but it never goes down. You'll never lose money in that account. Don't put your money in a savings account at your bank, because they're going to give you like 0.01%, and they're going to catch you on fees, and they're going to use you to make money. You will not make money through your bank. Your checking account does not make you any money on interest.
Any money.
Yep.
So yeah. Okay. We can basically, guys, the podcast just started. I know you've been listening for 30 minutes, but it just started, because this is rule number one.
Yep.
Take 3 to 6 months of your personal living expenses and put it in an interest-bearing savings account.
Yeah, not a CD, by the way. Not a CD.
Not a CD. Not a CD. Get that back if you need it.
What does CD stand for? by the way.
Certificate of deposit? No.
Yeah, something like that. I think it's like
Certified.
It is a certificate of deposited account.
Okay.
And I learned about. My mom told me about this. It's basically money that you don't want to touch once you put it in there, and you should, because it's only going to make that interest if you let it go within that certain time period. So it's probably not your best option because the ally, like you said, it's got
30-year terms. Sometimes.
Yeah, you have to buy them on terms, so you can't really touch the money until that term's up, or else you forfeit like all that interest and probably extra fees.
Yeah.
So what Nico's saying is like a thing like Ally Bank, it's got a better interest rate, but you can access that money when needed.
Yep.
So I got something for you guys here.
Wait, hold on real quick. Is this like a Roth IRA though?
No, those are very different. A CD is basically just a guaranteed return on money. So if somebody says,
don't buy a CD, guys.
Don't do it.
Yeah, don't buy a CD.
You don't have access to that money.
Buy it for your grandkids, okay? Don't
buy it for your grandkids. Give them an index fund.
Okay, whatever. If you're trying to get money saved up for the first time in your life, first of all, control your spending. Second of all, take 3 months of earnings and put it into an interest-bearing savings account, bank account, liquid cash. Okay? Start there.
Step 2, pay off any debts that are costing you more than 6%.
Oh, God.
Because that's a guaranteed 6% return on your money. The market is not guaranteed. On average, it's 6 to 7%, but it's not guaranteed. Pay off any debts that are charging you more than 6% first before you put any money into investing. If you have debts that are charging you at like 3% or 4%, that's where you might actually make more money investing that money than like paying off that debt. So don't worry about that quite as much. You can pay off the debt slowly, but anything more than 5 to 6%, get rid of that first.
I had a law school loan. It was 8.3%.
Oof.
And I paid that off first thing because I knew that
would linger.
Unless I had a guaranteed like 10% return on something, there was no better way to make money than to pay off that loan.
Yeah.
So
I did the same thing with my student loan. I got rid of my student loan first.
Nice. And then your credit will go up when you do that.
I'm still
and
it is touching like
student debt is tough. I think that's one of the
rule number 2.
Yeah.
Pay
off high interest debt.
Any high interest debt. I don't know why I'm writing this down. I guess for you. If you can read that.
I can read that. That's great.
Hardly legible. Okay, great. All right, we're making progress here.
All right. Now you're ready for investing. You've got your emergency fund set up, and you've got anything that's costing you like more than 5 to 6% paid off, hopefully. Now you're ready to start. So you got some more money, you got some more funds. Now you're ready to start paying that off. All right. Next thing you do is you can start investing. But, and this is where Wes's question comes in. When you start investing, do it through an IRA first. The reason for that is because the government taxes you on the money you make. And so everything you make, you're going to get a little chip taken off of it every time. Anytime there's like dividends going out, you're going to get some money taken away from the government. Anytime you want to sell it and like buy something else, you're going to get money taken away from the government. And capital gains taxes are 20%. So let's say you buy a stock, not to get dividends, but just you're going to sell the stock down the line. You bought it for $100. It increases to $200. Wow, what a great investment. Well, the government's going to come in and take $20 of that away. So 2% of that growth is gone from the government taking it. I think my math's correct there. I tried to keep it to 100, so it was easy. So you have to keep in mind that, when you're just doing regular investing that's not an IRA, the government's going to take bits out of it and it's going to impact your growth. Just like, the person managing the fund is going to have fees that impacts your growth. And the whole idea is that you're only growing at 5 to 6 to 7%. So you really got to minimize these things that chip away at that. So an IRA is a tax sheltered investment account. And there's 2 flavors of it. There's a regular IRA, there's a Roth IRA. I'll give a quick overview of them. So a regular IRA, you put money into the account without having to pay taxes on it. So like, let's say you've made, $1,000 and you want to put it into your IRA. The government will not charge you taxes on that $1,000. Because for every dollar that you make, you're really only making 70 to 80 cents because the government technically is, taking that next 20 to 30%. So this time you get to keep all of your dollar, 100% of your dollar that you earn, and you get to invest that. So right there, you're already saving money. And then in that IRA, which once again, you can buy any stock you want, you can buy any fund you want. It's basically just a categorization of that money. It's not an actual thing. It's just a categorization. Anything that you now have in that IRA gets to grow tax-free. You can buy and sell stocks within it tax-free, as long as you don't take the money out. Then finally, when it does become time to take the money out, and here's the catch, you can't take it out until you are 60 years old. Once you do take the money out, you will pay it in income tax on that money, but only income tax. You don't have to pay your capital gains or anything like that. So the bet with an IRA is that you're making more money right now than you will be when you are retired and pulling money out of it. And if you are making more money when you're retired, well, good job.
Good for you. You got that
Yep.
extra money there. But yeah, you're doing great.
Now, for those of you guys who are, the government's going to raise taxes, big government, et cetera, you have something called a Roth IRA. And the Roth IRA is basically the same thing. Your money that's now invested in that IRA gets to grow tax-free. However, you've paid your income taxes up front. So if you made $1,000, you're going to have to pay the government the income taxes first. So you really only get to keep, 70 to 80% of that.
Okay.
Yep. And then you get to invest it. But when you take it out, you don't have to pay income tax on it.
You get that lump sum, that full amount.
Yep.
At the end
No
of
taxes on it at that point.
So it's just less on the upfront that you're depositing if you go with the Roth because they take it out initially, or you wait until you're 60 and have a big chunk of that taken out after the fact.
Exactly. And honestly, at the end of the day, it all comes out to be kind of the same thing. Because, one, you're starting with a smaller number and then growing it tax-free. The other one, you're starting with a bigger number and you're growing it tax-free, but then you have to take a chunk out at the end, So
Also
somewhere in the process.
How long you're holding the IRA for.
Yeah.
Too.
The Roth IRA income up front one, can you also put money into that for stocks as well? Or is it just...
Yeah. You can buy stocks through your IRA. Yep.
And you'd probably want to go low risk on that, right? You'd probably want to do more bonds than stocks.
And actually, no, you'd want to go high risk on your IRA unless you are old. So I thought the idea behind the IRA is that the government wants to encourage you to save for your retirement. So you can only, like I said, you can pull money out beforehand, but there's a big penalty. Generally speaking, you can only pull money out
after
when you are 60 years old. So that right now, for me, that's 26 years away. Which is kind of scary when I think about that. But for most people here in this group, it's somewhere between 20 and 30 years away. So that's a long time. If the stock market dips like it just dipped last month, it's not going to be a big deal 20 years from now. That's where the whole law of average comes into play. The stock market averages 7% a year. Well, over 20 to 30 years, you're probably good. In fact, you can't pick a point in the stock market history where somebody can buy money and then have lost money if they've held it in the stock market for that long period of a time. Even if you bought at the worst possible high and you are selling at the worst possible low 20 or 30 years later, there's no way to do that right now to actually have that work out to have you lose money because it's just the stock market averages at 7% over time. So you actually want to go a little bit higher risk for the longer time that you have in the market. If you're only going to be in the market for a couple of years, go really low risk. If you're going to be in the market for 30 years, go high risk because that time mitigates that risk.
The average. Gotcha.
Yep. Yeah. I mean, don't buy crappy stocks. Don't go too hard on it. Be smart.
Go straight into penny stocks and call it a day.
Yeah.
Question with the IRA, is there an option to kind of do it in the same index way where it spreads it out, or when you're doing IRA, you're specifically choosing companies and stocks?
You can buy literally the exact same stocks, index funds, mutual funds, et cetera, ETFs. You can do the exact same thing in an IRA that you do in a regular brokerage account. It's literally just a classification for that money to not get taxed.
It's more for retirement and non-tax.
Yes, the whole idea is for retirement. And you can actually, so you ready for some more catches? There's a limit to how much you can put into your IRA. It's I think it's $6,500 a year. So you can't put more money than that into your IRA to save up until you are 55 years old. Then you can put more money into your IRA if you want, because it's just going to sit there for a few years. But yeah, so just be aware of that.
Your IRA gain interest?
Yes.
Does that interest fluctuate?
It depends on the stocks and the indexes that you buy.
So yes.
I don't buy any. I remember when I was 18, my mom had me invest like 5K into Roth IRA, and then when I became like 19 or 20, like I'm still in college, but like I'm broke, and I'm like, I need to get my money out, And so like I went and I withdrew it, and they're like, it's a high interest rate if you want to withdraw right now, and I was like, cool.
I needed. You just needed it. Gotcha.
Now, you know what I mean? So like that 5K ended up being like maybe like 4,200 or 3,500, something like that. But for me, I was like, cool.
Yeah, it's a 10% penalty.
But you lost
if
that
you do an early withdrawal.
You lost that 10%, obviously, because you're young and you needed the cash now.
But that Roth IRA is what gains interest, unattached to any stocks or anything like that. It still gains interest all the time.
Yeah, we should be clarifying. You're saying interest. Technically, that's not interest. You gain interest on, like, say, a bank account that's giving you interest. When you buy an index fund, you're not gaining interest; you're gaining value. In an index fund, it pays you in many different ways. There's dividends, where if you own a stock in a company every year, they give you a percentage of the profit. There's the actual value of the stock itself going up, but that's not interest. That's just people tend to use the word interest interchangeably because we're used to interest just referring to how much money you're gaining over time.
Adding on top, yeah.
Yeah. So just want to be clear on that.
So you gain dividends off of an index fund, correct?
Dividends are off of so remember, an index fund is just a collection of stocks. An index fund is just, one stock from Apple, one stock from Tesla, one stock from Facebook, anything, any company, like Jake said, there's farming index funds that are, food related and all these different agriculture businesses. There's textile index funds. There's health company index funds. There's the entire stock market, broad stock market index funds. And they are comprised of shares of individual companies. And because it's a group of people buying into it, aka that's where the term mutual fund comes from, they can, rather than you having to be able to afford an entire share of every company, you can just get a portion of a share because somebody else owns the other portion of a share. So you only get dividends if you happen to own shares in a company that gives dividends for their stocks. Many of them do, but different companies are different. Some companies try to have a very even stock price, and they have just a decent dividend payout at the end of the year, which is similar to, say, how Ally gives you a 1.5% to 2% on your money that's in their bank account at the end of the year. Other companies don't give dividends, and they just try to have their stock value grow, and then you make your money in that company not by the dividends, but by selling the stock after the value has ideally gone up.
Cool. Well, I'm gonna jump in here. I know we're jumping all over the place, but I'm kind of dial it back for the more layman's person listening or watching. But yeah, just kind of bring you guys up where I'm at. So, and also to kind of answer Jake's opening question of like personal finance and where we were, I would say, as I got into my professional career and after I kind of got past that point of obviously I'm making enough to live where I live and basically the cost of living. There was definitely a moment where it was like, okay, now I see the value of like taking some of that extra money that I'm making and making sure I save it, because it's obviously a great idea to, in case anything goes wrong, it's good to have a little bit of a savings going, right? And now, now we go like till today or, present time. I feel like I've done pretty good on the step checklist that we just did that Jake wrote out, started building a savings, got rid of the debt. And now I'm at the point where I'm like starting to realize, okay, I've got a grasp on my cost of living and how to, just save money on my own. Now I want to get to a point, and now that I'm researching and learning, with you guys and Clint, like how do I start investing to have my money make money for me, right? And so that's kind of where I'm at. And so yeah, where I'm starting at is that I joined that Betterment app, and it was very intuitive and super easy to think. So I'm basically at the point of where I've put a little money in to invest in an index fund, and I chose one like the S&P 500, right? So it spreads it across the whole thing between stocks and bonds, and then obviously it's a long-term thing. I started like yesterday, so I'm not going to see profits right away, but it's a long-term thing. We're talking like, in 5, 10, 30 years, you want to look back at that money that you're putting in. to, grow for you. So then you can, it'll be valuable to you later. And that's kind of where I'm started at, but then, yeah, obviously the next things I do want to look into, obviously there's all kinds of tools of like how to buy a home or how to save up for kids. But yeah, the next step for me is that I want to look into this IRA/retirement fund. Like it would be nice to know that when I decide to stop working that I'm still set, so that's kind of where I'm. So I'm like, yeah, I've got the fundamentals of those steps done. And I'm just now dabbling into how do I, where do I put my kind of overflow cash into places where it can start making money for me over time. So that's where I'm at. And I mean, yeah, right now this is all super helpful. I think all the IRA talk that you were just talking about has definitely piqued my interest because a retirement fund is something that, I think Clint, when we were on set yesterday, said something like a stat like, yeah, like when you start at, or even Nico might have said it, like when you start at 25, that's kind of like the trajectory of how like to set yourself up for a good future. So I'm 28 now, maybe a little late to the game, but like you said, there's no better time to start than now.
Yeah, it's the best time to invest was 10 years ago. The next best time to invest is right now. Yep. Even if this market is high, like don't put all your money into it at once.
Sure.
But over time, just a little bit every month. Even if it's high, don't try to time the market when it comes to long-term investing. Whether you bought at a peak or a valley does not matter 20 or 30 years down the line.
Yeah, that's what I kind of feel like too. Yeah, I don't want to go, I'm on the Clint side of things where it's like I don't want to be the guy that's looking at every individual stock and trying to play the market like that. Like, I wanted to know that it's going to a good cause, but I kind of wanted to, like you said, invest it in things that are more secure in the long term, whether or not it's low or high right now and things like that.
Yeah. The hardest challenge that a lot of people go through is the emotional ups and downs, like the 2008 crash, or right now with the coronavirus crash, I guess. It wasn't really a crash, but it definitely went down. It's scary, and you see
a crash.
I guess, but it bounced back pretty quick, to be honest.
It was like a dirt crash, and then it kind of like this,
like recovered from the crash.
Oh, we're still in the air. We may have lost a wheel, but whatever. Yeah. So I think I saw my investments, my savings, my retirement savings go down by 25% when that happened. It's like, that's a lot of money that I was saving up that just disappeared. But I also have to remind myself that a lot of that value that I saw was because, I started investing like 6 years ago at the request of my wife. She's like, Nico, you should start doing this. And that's when I started my first IRA. So when looking at it in that regards, like I was still just back to where had I not done anything, like I would have had the same amount of money I had after in the middle of the crash, the worst point in the crash. So knowing that even, I was really just losing my gains. I hadn't lost anything of my actual money.
Of the initial investment. Yeah.
Yeah. Cause that was 6 years ago when the market was already at that level, or below it actually. But the thing is that really tests your emotions when you see that money, all that value go down. And you just have to remember, it's a long haul thing. Just let it ride. It'll come back up. And if it doesn't, it means that the world is fucked and you're just in trouble. Don't worry about your retirement savings anymore. You're not going to retire.
It's something else. The bigger issue.
Dollars aren't going to be worth anything anymore. How much money you have does not matter. So that's the thought process you should have. So even when you see it all go down, just let it ride. Right now the market's already back to the point where it was in November of last year. So I'm back up to, yeah, it's crazy. That's how fast it bounced back up. It's not always going to be like that, but it's you gotta take your emotions out of it. You gotta put it in there and just be like, I'm not going to worry about it. I'm going to let it ride. It might go down. It might go up. I'm not touching
January of last year. Yeah.
Do you take the money that you earn and then reinvest it?
Yes, I do. When I have, so for example, let's say you have an investment in your IRA. And you have, let's just say you happen to buy an Apple stock, right? You didn't do it fine. You just straight up just bought one share of Apple. And let's say Apple pays you a dividend. You can decide to reinvest that dividend back into another stock. Or so for example, let's say you own $1,000 in an index fund and the different things in there pay dividends. You can have it just buy more of that index fund if you want. Or you can have it, go out and sit in cash for you to do something with later if you want to. But I have all of my stuff that's in long-term savings, just automatically reinvesting the dividends.
And that's through the regular IRA, correct? Not the Roth
You can do
IRA.
that through anything. Any index fund, you'll have the option to reinvest dividends.
So question, are you currently still putting money into all of these funds, or are you at the point where you're just reinvesting dividends?
I still put a little bit of money into all these funds. To be
Do you
fair,
focus on any specific one where you
Yeah.
still deposit? The IRA or the index fund or the general investments or anything?
Yep. So this year it's a little weird because I'm buying a house, so I'm not putting any money into funds. I'm putting the money into a house. But when the stock market went down with the coronavirus epidemic, I did put a little bit of money into Vanguard's total stock market index fund. So the total stock market was down. It was suppressed. I didn't want to have to research individual stocks, and so I just put a little bit of money into that, anticipating like, hey, maybe it goes up 10%.
Probably going to go back up. Mm-hmm.
Yeah, maybe I can make 10% of that money, which isn't huge at the end of the day, but if it takes you a minute in the evening, just like do a little transfer, and then a few months later in the summer, it's like, hey, I made $100 or whatever. It's like, you made $100 for a few minutes.
Now, is that through your regular Vanguard account, or is that through one of the IRA vehicles?
That's through Vanguard. I wasn't putting into an IRA, but you can. Like, once again, it's important to remember that the IRA is not anything really special. It's just a category. Like, if you're on Vanguard, you'll see like your brokerage account, and you'll see.
They ask you can select different vehicles within it. It's just like a coat for your money. That tells the government when you want to be taxed on it.
Yep, that's all it is. So you can buy the exact same stocks, index funds, et cetera, in an IRA that you can in a regular brokerage account.
So you're saying when it dipped, you put some money into the index fund of just the overall stock market. Would it be comparable to just the S&P 500, but you're talking about the specific?
Yeah, it's basically the Vanguard's equivalent of what
the overall stock exchange. Gotcha.
Yep. So the two funds that I put most of my money into is the Target Retirement Fund and the Total Stock Market Index Fund. The stock market index fund is the risky one. That's the one that is just pure stocks. The stock market goes down, it goes down. So like if I, for example, saving up for my down payment, I didn't put that into the total stock market index fund because there's no guarantee that would be where I needed it to be. Mm-hmm. Yep. I didn't even put that into my target retirement fund. I mean, I put a little bit in there, but most of it just went into Ally and sat in Ally. Because I didn't want to have the risk exposure. And I started saving for down payment like about 5 years ago. And there's no guarantee that you're going to make money in a 5-year span. That's actually a pretty short time span when it comes to long-term investing. So that's why I went with the really safe route. But yeah, if people are like looking to get into this, I would recommend starting with I'd recommend starting with the retirement fund. Like I have a Target Retirement 2055 fund, for example. And then if you're feeling a little risky and a little frisky, you can put a little bit more money into yeah. Then you can put a little bit of money like into the total stock market index fund. And that one I time it a little bit sometimes. Like if I see it that it dips down, and I've been waiting to put some money into it, I'll do it then. But it doesn't really matter at the end of the day. So yeah.
So those are the types of vehicles that when you actually start putting dollars in through an investment, whether that's through an IRA or just through like a Vanguard or a Transamerica account or what have you, you're talking about like broad strokes vehicles.
Yep.
One that indexes entire stock markets, another that's a mutual fund, another that's something that's going to be low risk long term, whether it's high risk now and it's like through an IRA and it gets more low risk over time or what have you. But that's where you want to start is like, so now you're talking about like 3 to 6 months of your savings of your personal like cost of living, right? Is now that's in an interest bearing savings account. And then what's rule number 2, guys? We've got high interest debt. You've paid off your high interest debt, right? And now you've got your vehicles. So that's now after that, that's when you can start. That's when at least at that point, that's when I started thinking about like, hey, what are some blue chip stocks that I can buy? How's this company doing? I wonder if I can buy this one and what'll happen if I give them if I buy one share.
Yep. And that's, only once you have everything else kind of covered is it time to start doing that. And that's like, for example, I'm pretty confident that Google's going to continue to make money. And so I bought like one Google share. I'm pretty confident that Amazon's on the path to continue growing his business. So I bought one Amazon share. Like, if you're in an industry and you're very close to how the economics are working in part of the industry, feel free to rely on your knowledge of that industry and buy a couple shares.
Like my Adobe stocks, guys. I bought Adobe at 220, son.
What's it at now?
350.
Wow. So yeah, if you're close,
Adobe wave.
Yeah. But I wouldn't just go willy-nilly buying things.
Totally.
Like, I think this company is going to be good. So you might be thinking to yourself, all right, cool, like 6%, 7%. Wait, if I have to invest like 10 grand just to make $700, like that's so much money to like just make a little bit back. So you might be looking at the percentages and thinking that. And here's the thing. Here's the trick. So at a 7% gain each year, your money will double every 10 years. So if you're 25 and you put $5,000 into an IRA and then you didn't do anything else until you're 65, you literally didn't save a single penny. Well, from 25 to 35, that's going to become 10 grand. From 35 to 45, it's going to become 20. From 45 to 55, it's going to become 40.
And that's without doing nothing.
To 65, it's doing nothing. It becomes 80. So that $5,000 becomes $80,000 by the time you retire. Just sitting there. So if you are every year putting $1,000 into retirement, or a little bit more if you can, that really adds up. And if you think about it, people are living longer. If you retire at 65, you'll probably make it until your 80s at least.
Now it's not $80,000 in today's money, but still.
No, that's true. But still,
it's worth, it goes to show you.
That's a full year of high living when you're 65.
Yeah.
For $5,000 when you're 25.
Yeah.
Yeah. So if you can keep doing a little bit of that every year, it will really add up, and you'll be able to have some money when you get old.
I just got to ask a question. So the 7% gain each year, that is associated
Sorry, Wes, Jake knocked over his microphone. It totally obscured what you were saying. Can you say that again?
So the 7% gain each year, or I guess that's you're saying 7% gain each year, you'll double it every 10 years, correct?
Yes.
7.5, yeah.
Every 7.5 years, not 10
no,
years?
7.5%.
7.5% doubles every 10 years.
Okay. And then, and that is through any type of investment? Or are you talking about through Vanguard? Or are you talking about?
You're saying an IRA and retirement fund, right?
Any value.
Anything.
Anything. Any value. If I own a single share of Apple, and for the next 40 years, Apple's share price goes up 7.5%. This is just simple math. Mm-hmm. So any average that you can garner anywhere in any investment, if you can average 7.5%, you're doing great.
Yeah, it means your money will double every 10 years. In the stock market, remember, historically averages around 6 to 7%. So it's totally feasible to actually have this work for you. Like historically, it works. So yeah, do not be discouraged.
Let me ask you this. All right, so say I invest in Apple and it is like $400, right? Mm-hmm. And it jumps, by the end of the week to $700. Mm-hmm. 4, 5, 6, $400 profit, right? On that.
Mm-hmm. On that one share?
On that one share. And I want to take that $400 and I want to withdraw it out and then spend $400 on, I could either move that stock someplace else or use that cash to withdraw, put it in my account, or buy other stocks, correct?
Yes, but you will have to, of course, sell that Apple share to realize that gain.
So you'll need to pay a brokerage fee to sell that share, depending on which service you're using, which can be anywhere from like $1 to $5. And then you'll also, if you don't reinvest it or its profit at the end of the year, you'll need to pay capital gains tax on it.
Yeah, unless it's in an IRA.
Yeah.
So
you can't just use that 400 and go take it somewhere else without actually giving up that one Apple stock.
Yeah, you'd have to sell the Apple
stock.
stock.
To sell the Apple stock, yeah.
And you'd have to pay Uncle Sam his 20% capital.
Yeah, he always wants
So every time I pull out cash and say, hey, you know what, this is more my buying power now that I've earned. I want to put it in as like buying power.
Mhm.
I pay capital gains on that.
Yes.
At the end of the year, yes. At the end of the year, whichever institution you use to do your trading will send you a tax form that says how much you made or lost that year, which will be taxed at capital gains.
Yep. And part of this is because they actually don't want you to be constantly buying and selling, buying and selling,
pulling
buying and
money out.
selling.
Yeah.
Well, that's
Is there a way to do that without pulling it all the way out to be taxed if you're planning to just reinvest it right away anyway? Or
Nope. Because, well, here's the thing. Here's how you have to think about it. You only get taxed when you make money, right?
Yeah.
You're not going to tax if you lose money. So let's say you started the year with $100. You bought a stock, it grew to $200. You sold that stock. Now you have $200 to play with. You bought another stock, it grows to $400. You sell that. Now you have $400 to play with, and then et cetera, et cetera. And then at the end of the year, now you have $1,000. Well, you've made $900. That's income. The government's going to charge you capital gains or and other types of taxes on that money. But if at the end of the year you made a bad decision also and then you lost it all and you're back to 100, you don't owe them anything. You'll just pay them because the losses will offset your gains. So you have to only make money to have to pay capital gains. But you will have to pay capital gains anytime you have sold something and made money, even if you buy more stocks with it.
I was going to say, so even if I put that 900 profit back into stocks, I'm still paying taxes on that 1,000. So I still have to have that money to pay the tax, even though I'm using it to keep playing.
You're not caught a lot of people by surprise with Bitcoin.
You're not buying a stock like individually from Apple. You're not going to Apple and being like, hey, Apple, hey, guys, can I buy one of your stocks, please? You're doing it through a brokerage firm.
Yeah.
And the brokerage firm will issue you a balance at the end of every year that shows whether you gained or lost. It'll be like, here's where you started, here's where you ended. So because of that, this is how much you owe the government.
So they'll always give us a P&L printout.
Yeah,
but only if you sold. Only if you sold.
Yeah,
if you're just holding it,
that's true.
Yeah.
Only if
your gains have to be realized.
It's a tax form. It's a basic tax form. But every brokerage entity that you use to buy and sell any kind of vehicle, whether it's an individual stock or a fund, will allow you to take any money you've earned and put it back into something. It's not like you need to take it out, put it in things, then take it back out of your bank account, then put it into a new stock. They'll save you that step.
So you're just saying as long as you don't actually make it into cash first and you just reapplying those funds to other options, then you're not going to get taxed until you make it cash, which you've had, and then you have to get it back.
What you will at some point.
Yeah, at some point you're going to want it. Yeah. At some point you're going to want that cash, and then it's going to be taxed.
Yep.
So what were you saying about Bitcoin with that?
Oh, a lot of people got caught by surprise with capital gains taxes on Bitcoin. Because everybody's like, oh, I held on to some Bitcoins, and now they're worth like $1,000. They're worth $10,000 each. I'm going to sell my 3 Bitcoins. I made $30,000. And the government's like, you owe us $10,000. And everyone's like, ugh. Because then a lot of people,
I used all $30K. I used all of it though.
And a lot of people are like, I have $30K. Now I'm going to buy more Bitcoins with that $30K. Oh, it went down. Shit. But then what happens is like it went up in like say 2018. And they bought all those Bitcoins in 2019 and then lost all their money. Yeah. But the government's like, well, in 2018.
At the end of 2018.
2018, you had that cash in your hand. Yeah. And so you owe.
You can carry losses over and do that kind of stuff, but you have to wait till 19 to do so.
That's a good thing because I've been investing in like crypto as well. And, everything I've started out with is just small money. All the stocks I've done is just kind of like individual. Let me just see what it does. Not really big money. And I finally was like, you know what? I'm going to put more money into like crypto. So I went and bought coins. And today I noticed I gained $600. All right. $600 off the money I already invested. So.
Well, it's unrealized gains. Just to be technical here, though. That's unrealized gains.
Why is it unrealized gains?
Because you actually haven't made that money. You haven't the value is higher, but until you sell it, you don't actually have that money.
Yeah, you don't have the profits until you've actually sold it.
You don't have the profits until you sold it. Okay, so still at the end of the day, say I sell it, it's going to kind of go back to like is it going to go off because the value changes, since this is a 24-hour 24-hour like thing. The value changes. Some days it's low, some days it's high. But like when it's high, that's when I would sell. So it's tax me off of when it's high or what I initially invested.
I think it's going to tax you off of what you deposit, what you sell at. Like, so if you said you'd invested 600 and you're selling it at 900, you're going to get $900 in the bank that has to be taxed.
Correction, $300.
300.
It's the difference between what you bought and what.
Gotcha. So just the gains. Just the gains. Okay.
Yeah,
just the gains.
Interesting. Okay.
Because your 600 that you already put in was taxed when you earned it.
Gotcha. Okay. No. Okay.
It's also going to be taxed when you take it out because I see I'm going through Coinbase. There's a Coinbase fee on top. It's like 1%, I believe, on the exit of your coin. So it could go up to like $2.99 per dollar, I believe.
Well, that's Coinbase's fee. That's Coinbase just charging you for doing business with them.
Plus the capital gains.
Yeah. Plus what the government's going to take for the capital gains.
But the capital gains, it's only on the difference between the money you put in and the money you take out. If the money you took out at the end of the day when you sell it is higher than the money you put in, it's that difference
it's
that
just
you
the
get charged
difference.
on, not the entirety. Yeah.
So in Wes's situation, Uncle Sam would be taxing him on that 300, but then Coinbase is also taking 1% of either that whole thing or even still the difference.
The whole thing, if I'm selling the whole thing out, it's taking.
So say you bought in at your 6, you're selling at 9. Uncle Sam's taxing 300 plus Coinbase is taxing 900, 1% of 900 for their fee just to manage what they did for you.
Yep.
During tax season or like from the year date?
It'll be in that tax season, right? So if you took out this year.
It'll be the entirety. It doesn't matter what the year it is. Like it's just the difference between when you bought it and when you sold it. Whether it's within 1 year, within 10 years. Yeah. It's just that it's all that matters is the difference between what you bought it for and what you sold it for.
But I'm just saying you pay that tax on that year's taxes, right? Because that's when you deposited the money. Yes. That's when you took out the money.
Yeah.
So if you took that 900 out today on your 2020 taxes, you'd get taxed on that 300.
Yeah.
Okay.
But let's say you also sold another stock that had lost $300 this year. At the end of the year, it would show a $0 difference because you lost $300 here and you gained $300 here, meaning that your net was 0.
So you don't really want to take something out.
And
it's made 15 to 20% more than where you started at.
Yep.
Is the message here.
Well, this is why this is the long haul. This isn't just like
then you're just gonna
hop
get
in this isn't like a hop in and try to get your money back in a month and try to make a little cash. It's like this is like you're really planning for your future here.
That's what I was doing at first. I was like, oh no, let me go and sell this and buy some more of this. I was like, the first day I got into this, I was watching this shit all day. Sun up to sundown, I'm looking at this stock market 4 hours after hours. And I was like, this is not any way to live because I'm going into
no way to live, guys.
Yeah, I think that crosses over into like where it's more like gambling. Like what we were talking about. It's like you're trying to play the specific stocks and you're hoping to get the right hit.
Fun if you have every other base covered and you're like,
yeah. If it's straight up just
here's $300. What the hell?
If it's just your fuck you money, then of course. Then it's like gamble with it.
But that's not like what you want to be doing with your
your future
retirement
your future goals. Yeah, this isn't the Vegas fund where you're already planning to lose this when you're at the tables in Vegas, and if you happen to walk away winner, good for you. But you were already planning on losing that.
Let me apologize. The money, it's gone.
Got too deep in the stock market.
But if you give me more of yours, I can.
Let me call the rest of my family for the 8th time. That's not the conversation you might be having. Yeah.
I think one other good rule of thumb too when it comes to investing is if you're going to invest in something that's not a broad index fund, ask yourself, like for example, cryptocurrency. Do you think if you're doing it short term, that's one thing, and honestly, cryptocurrency is a short term game. Long term, do you think that cryptocurrency is going to be more reliable and increase in value more than the entire American economy over the next decade? Who's going to win, the American economy or cryptocurrency? Some people would say cryptocurrency. So I'm not saying there's
some of those rebels out there.
Yeah. But yeah, I'll take my 7% of the stock market.
I don't know. I'm playing both right now. I feel like they're both important because it just seems like the value of the dollar is just becoming less and less. Like if they're printing out trillions of dollars, I kind of wonder like where are the trillions of dollars coming from? Doesn't that mean like the value of our dollar?
So you actually bring up a good thing with like printing, quote unquote, printing money. So when people say printing money, it's a colloquial term because the government doesn't actually just print more money. So printing money means bringing more money or increasing the amount of money in circulation or putting more money into, the money supply. Yeah. That actually happens through loans. So each bank is required to maintain a certain amount of money within the bank. If you guys remember back in like the Great Depression, people had runs on the bank. We're like, oh shit, all my savings are in the bank. I want my money right now. And the bank's like, well, we just had to give that guy back his savings and that guy back his savings. And we actually don't have any more money for the money that we owe you.
I believe.
What's that?
I believe it's 10% of all money they have out in loans. They need to have 10% in actual cash as required by the Federal Reserve Bank.
Yeah. So right now, Wes, let's say that you have $10,000 in the bank, right? And let's say that I also have $10,000 in the bank, and Clint has $10,000, and Christian has $10,000, and Jake has $10,000 in the bank. Well, if we all went to the bank right now and all wanted our money back, they wouldn't have enough money to give all of us because they're taking that money and they're giving out to people in loans. Like, here's $50,000 to you, and you'll pay us back this percentage every year. Here's $10,000 to you, and we have to keep the rest here in the bank just to be safe.
Go ahead.
I was gonna say, but perceptually, we all still feel like we all individually have $10,000, right? Like I have $10,000 in the bank and you have $10,000 in the bank, but now there's another dude walking around with a $50,000 loan. So somehow the money supply just went up. We all have $10,000 in the bank, and there's also now a guy with $50,000. So that's how inflation,
the credit reserve system works.
That's how more money gets added or printed.
For every
that's how more money gets printed.
For every $10 effectively that you have in actual cash, there's another $90 out in loans somewhere in the economy that are expected to be paid back to support that actual $10 amount, which is why the economy is so much larger in a credit reserve system than it could be. So people always say like end the Fed, and there's always that rhetoric that goes around, but actually what the Federal Reserve Bank allows to happen is that exact process. It allows $10 to become $90 instead of it just being $10.
And that's how you print money.
But there is a requirement that each bank needs to have certain amounts in actual cash. And then also when there are spikes and there are depressions in the economy, the Federal Reserve can step in and say, hey, we're going to give out a loan to all of these different financial institutions to then take that and to do with it what they think is best in terms of like, hey, where's a safe investment right now? Should we give it to people that are trying to buy houses? Should we give it to people that are investing? Should we give it to new businesses? What should we do with it? And then the bank tries to determine where the best places to get their money back is, because eventually they need to turn around and pay the Fed back. And then the Fed, after they get that money back, they then take down the federal balance sheet. So that
is what's going on right now with like the SBA loans and the other disaster loans.
Yes, and that's exactly what happened with the Troubled Asset Relief Program back in 2007, 2008. And now if our government could stop spending money, that's a different conversation. But that is, all of that goes in to make up what is known as like the federal, the national debt.
There's a lot of information. This is a lot of information.
People have studied volumes on this, and I mean, we're barely even getting definitions right, guys.
Yeah, I was going to say. I mean, people do this for their full-time job, and they're still learning things and stuff. So,
yeah,
I think this was a good first lesson.
Yeah.
At the end of the day, target stock or stock market index fund or Vanguard retirement fund. Those are my recommendations. If you're going to start with, there is one catch. Vanguard has a $1,000 minimum to start with a fund, so you have to save up to that point. But if you're saving up to that point, something like Betterment is a great start. Before you do any of that, first you need your emergency fund.
Wait, I thought you said emergency fund or pay your debt first.
Emergency. I'd say
do emergency fund.
Yeah,
first.
I'd do emergency first.
Because honestly, like you don't want to burn yourself trying to pay off a loan and then have
nothing,
and not have saving.
Yeah.
I would put an emergency fund before everything.
And if you're listening to this and you're thinking, I don't need an emergency fund, it's like, bitch.
How you doing right now? How you doing right now?
Did.
Yeah.
Like 20 million people just realized they needed an emergency fund.
Did the $1,200 you got make up for the amount of money you lost? Probably not.
So, emergency fund, cover your debt.
High interest debt. And then spread out index loans or
and
then retirement IRA.
Tax sheltered.
Tax sheltered.
That's the Roth, right?
Or either IRA. Either IRA.
Yeah.
It's whether you want to pay taxes up front or when you deposit it later.
And if you have a 401k through your work, that's also a tax sheltered fund. Fees are higher on a 401k. They are because an IRA doesn't really have fees outside of whatever funds you buy if there's fees with those. But a 401k does have management fees. However, most employers also offer a match. So if you say put $1,000 into your 401k, a lot of employers match that. That's free money.
Put money into we just force it.
Yeah, we just force it.
Everyone's saving.
So, is it wise for someone to kind of get all these things? Like, I want to get a mutual fund, I want to get an index fund, I want to get a Vanguard, and I want to have a Roth IRA. Is that smart to make sure you have those things? Is that like covering all your bases, or is it you should pick one or the other?
Or is it overkill?
Well, first off, an IRA is not different. An IRA and a mutual fund are not the same thing. Remember, the IRA is just a classification. It's just, like Jake said, it's a coat that some money wears to say, hey, don't tax me. So an index fund can be the exact same index fund in and outside of an IRA. An IRA is just a classification that says this money doesn't get taxed on its growth.
But also better to save for later life, like retirement, right? Because
yes. So if you're saving
for
a
it
down
out too
payment,
early, don't put it in an IRA because it's going to be fees or interest if you try to take it out too early.
Yeah. You can think IRA. If you think IRA 401k, just think retirement.
Okay. Yeah. So the other investments are potentially stuff you can use if things blow up now, and you want to use that money
now if you need.
But IRA, you should be that's your planning for long-term retirement.
Yeah.
Yes. So you can pull $10,000 out of an IRA for a down payment on a house without any penalty.
Up to $10,000 is what you're saying? You could just pull up to $10,000 without an issue if you have it there.
I feel like you're the guy in Shawshank Redemption right now.
I know, man. I did a lot of reading on this.
Transfer wife tax-free. Trust your wife.
Yeah. At the end of the day, the government wants you to save for retirement. They want you to buy a house. They want you to be stable. And there's a lot of things in the tax code to do this. But ignore that. Ignore that. If it's going into your IRA, you don't touch it till you're 60. Just think of it that way.
That's just how you should look at it.
Yeah. I feel like what sucks to me is like, say you get paid through like PayPal. There's a fee associated with that, all right? And you want to PayPal money and then put it in, you have to put it in your bank and then you want to take it and use it into whatever, like say stuff like you're still going to be taxed again off capital gains. It's just like I feel like we're just getting screwed all the way around. Like there's you're never getting your full true dollar amount.
Welcome to taxes.
Yeah, welcome to America.
And Wes just became a little bit of a Republican just right there.
Dude, yeah, it's like you think about it, man, and it's like, yeah, you think about what we do, and it's like you got say it's like you take a brand integration, okay? Well, the brand goes to the agency, so you have the real dollars. Say it's $1,000, and the brand's like, I want to spend $1,000 on marketing. I made this $1,000 from selling a product to a consumer. So then they turn back around, and they already got taxed on it all the way through, right? And they got taxed on the storage fee, and they got taxed on the distributor, and they got taxed on the retail, and they got taxed on the gains, and they got taxed on the corporate tax, blah 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 blah. And then they're finally
they have 1,000.
I've got money. Okay, what do I do with it? They're like, quick, give it to an influencer. Okay, and then the influencer's like, okay, but what? Don't just
you left out the agency. You left out the agency.
Yeah. Don't go directly to them.
Give it to an agency. And then the agency's like, okay, we'll take your money. We're gonna take X amount of fee, okay? But then we don't actually know the influencers, okay? So you gotta go to the MCN, okay? So then go to the MCN, and then they like, okay, well, we're gonna take this much. And then the MCN's like, okay, cool. All right, we got this vertical right here. You guys are gonna sell so many pieces of toilet. You guys are gonna sell so much toilet paper. You don't even know. You don't even want to know. Okay, you get all this money back. Like. They're like, okay, and they're sharding across the agency, and the agency's counting its money, and then the MCN's like, okay, guys, here, guys, come on over. We got some money. Hey, we're gonna give it out, and then the influencers are like, oh, hey, but then one of them's like, I gotta pay that guy over there. I gotta pay this guy here. Oh, and then, I guess I made some money. Oh, I got operational costs for my channel. Oh, I better pay tax on that. And then I'll turn around, and then you turn around, and you're like, okay, how much do we make? How much did they make? And you're like, is that less than what they got? Wait, where am I in this ladder? Like, holy shit. Yeah, and then you turn around and you're like, okay, now I owe tax. Okay. Now I owe California tax. Okay. Okay. Now, I had to buy that car. Okay. Now, dude. And it just goes on, man. It just goes on.
That's the whole America.
Take that 1,000 and you end up with like 2, and you're like, hey, I'm just hoping for my 7.5%. Somebody, please.
That's insane. I love how you broke that shit down. Is it tax evasion if I'm like, say I'm working here in Cali, right? And I know it's 30% tax, but I'm like, you know what? Let me go ahead and move to Iowa where it's like 15% tax.
No, it depends. It depends on how you classify that.
Yeah. However, California's not dumb.
Yeah, they're going to ask you. They're going to say how much of your business enterprises were reliant on our state, and then they're going to say, was it X percent or was it X percent? And you're going to have to give them an answer. And if it's not an answer that they like, they're going to look into it. So you're like, fuck, okay, maybe it's this percent, and then they're like, all right, we'll deal with that now. But next year we'll have this same conversation.
Why is it like this? I'm so upset.
Wes, there's a saying. There's 2 things in life that are inevitable.
Death and taxes.
Death and taxes. And that's not a lie. you will pay taxes. That's just how it's going to be.
One day.
Because everything has a cost. That's why. Because everything has a cost. Everything has a cost, and that's just how it is in our economy. That's how it is in nature. That's how it is at every level. Everything has is equal and opposite reaction. And at the end of the day, you just got to try to make the process for someone to eventually get those $2 at the end of the rainbow, and make it as at least as easy as you possibly can, so that they can then turn around and do that again. And the more times that process repeats itself, the more revolutions that there are, the more wealth is created for everyone.
When you create like a mutual fund, can you take the individual stocks that you've already bought and put it inside of there?
No, you'll have to sell them first and then buy that mutual fund. Well, I think this is Jake's little spiel right there was a great note to about this podcast.
Ending. Yeah,
Wes,
perfect ending.
Thank you for being our everyman.
This is great.
Clint, thank you for inspiring this conversation. Clint ended up just not talking partway through, but Clint, you were the inspiration for this.
Yeah.
Well, I guess that's good. I guess. Glad. Yeah.
Great. I hope we can continue talking about this stuff, because I learned a lot. Right.
Sure.
And just like how I'm going to restructure everything that I thought I was doing right. Based off those new 4 steps to follow. So
it's always a learning curve. It's always a process. And yeah, like you told me the other day, every time I've ever lost money, it was because I thought that what I didn't know didn't matter.
Yeah.
That's super important. And I've been taking that to heart as well. So people helping people.
Yep.
Reddit.com/r/personal finance. I give them a good shout out for helping you establish basic investing techniques.
Wait, can you put that in the chat?
I'll text it to you sometime, Wes. r/personal finance. Just type that into Google or Reddit personal finance. All right, fellas. Everybody, thanks for listening so much. I appreciate it. It was good chatting with you dudes. I'm really into investments and actually talking about them. So this was a joyous podcast for me.
Yeah, let us know in the comments if you want to see more, and consider subscribing.
Thanks, everybody.